we'll just give about maybe 2-3 minutes for attendees to come in, and then we'll then start.
Okay.
I assume they can't hear us.
Sorry?
Michael, I assume nobody can hear us apart from us here.
I think, yeah.
Paul, I don't think you should assume.
Okay.
I think they all can hear.
Thanks for that advice. I think I'll keep my thoughts to myself then.
I think so.
Okay. I think we can start now, actually. So I think there are a considerable number of people in already. So good afternoon, everyone, and thank you for joining the fifth of our series of webinars at the Tokunbo Orimobi Foundation. The Tokunbo Foundation, just by way of background, is our only two way of giving back to the society in our law firm, Tokunbo LP. As most of you know, Tokunbo LP is a 41-year-old business, full-service commercial law firm with 10 offices in 7 countries as at today. And last year, we decided to find a way of giving back to the society, hence we formed the Tokunbo Foundation. The foundation is set up on a tripod of education, mentorship, and advisory. So what we're doing here today is one of our initiatives under our pro bono advisory business. And what we try to do under this mandate in the foundation is to create some thought leadership around ensuring that entrepreneurs, business owners understand certain things as regards certain sectors of the economy. Most of the times we try to focus on the Nigerian economy, but at times we talk about emerging markets, frontier markets, and I will say maybe globally at times. So today we'll be focusing on the real estate sector. We feel that this is one of the most important sectors for this economy and in the new normal going forward. And we thought it was good for us to have some conversation around that. Let's say a big thank you to our panelists for joining. You all are all C-suites and business executives, so your time is money. I'd like to thank you for agreeing to spend some hours with us today for us to tap into your repertoire of knowledge and experience in this sector. And thank you also, Lanre, my very good friend, for moderating. I think at this juncture, I would hand over to Lanre and then Lanre can take things forward. Thank you very much. And also to our audience for participating. We're most grateful. Thank you.
Thank you, Michael. Good afternoon, everyone. Thank you to the Tokunbo Orimobi Foundation for putting this webinar together. As you all know, we have a great panel lined up today. And from the number of registrations that we have, we know that a lot of people want to hear what these 4 panelists have to say. And I'm also particularly excited myself. I look forward to getting some great insights. So our topic today is COVID-19 and real estate development and financing in Nigeria. And I think that for many people feel that COVID-19 is an overflogged topic. And we know there have been a lot of discussions, panels, webinars for real estate. But I think the important thing is that we know that the effect of the pandemic on real estate is evolving. And we need regular discussions like this, which are a very useful tool for market participants to obtain ideas and discuss potential solutions. So, I mean, I'm going to provide some context before we get into asking the panelists questions. Over the last few months, we've seen how COVID-19 has spread around the world. And we know that people are unable to work, to meet, to socialize in the way they used to do so. We've now become very familiar with terms like social distancing. We're all very familiar with working from home. We're all very familiar with using tools like we are using now, Zoom. So the need for physical distancing has changed the way people occupy space. And absent a cure or vaccine, and we hope one will come soon, in some cases, it's actually reduced the demand for physical space in an unprecedented way. And coupled with this, we have economic uncertainty. People have been spending less, buying essential items only for many, and many people are getting these delivered to themselves where possible, as opposed to going out. And the knock-on effect of that on companies and on businesses, it's had a negative impact on their cash flow and profitability. And this has implications for their ability to pay their staff, payroll, or even to pay overheads like rent. So the global economy is expected to decline in GDP terms by 5% in 2020. And to put this in context, this is worse than during the global financial crisis. Governments and central banks around the world are responding to this health challenge with various public health measures, many centered on movement and travel restrictions. And they've responded with some of the largest economic stimulus packages that have ever been recorded. This also includes the Nigerian government, which has created an economic sustainability plan, which is a 2.3 trillion naira package to stimulate the Nigerian economy. And key projects include agriculture, a program of public works, strengthening the social safety net, support for MSMEs, a survival fund to provide payroll support for MSMEs, among other things. And specifically for the real estate industry, there's an ambitious housing program to deliver up to 300,000 homes annually. And also a focus on local manufacturing in the construction industry. So part of the plan is to support the local manufacturing of things like doors, windows, and other materials, which will now occur. So what is the current situation? We all know that there's been a collapse in oil prices, and the pandemic has put Nigeria, unfortunately, within touching distance of an economic recession. And the World Bank estimates that the Nigerian economy will contract by about 3.2% this year. The National Bureau of Statistics reported that Q2 GDP growth was negative 6.1%. And for real estate, it was nearly a 22% decline. And the construction industry contracted by about 32%. So what we have is a situation where we have uncertainty and a reduction in confidence, investment levels, and foreign remittances. So we know, we can see that we are in a contraction phase in the real estate cycle. But in the middle of all this, I mean, there are bright shoots, I guess, bright spots. UPDC recently announced that custodian insurance would take a majority stake. And they cited that they see an opportunity in the real estate space they want to exploit. We have investment platforms being launched to invest in real estate as well. So, you know, the investors that see opportunity, and perhaps we can be cautiously optimistic. So that's the background. I would like to introduce the panelists for today. I think many of us on the call know them, but I will say a few brief words. I'll start with Olaide Agboola, who is the co-founder and CEO of the Purple Group. Purple Group are the developers of Purple Maryland, or formerly known as Maryland Mall, and many other residential developments. They are in the middle of launching an ambitious mixed-use development in Lekki called Purple Lekki, and we'll talk more about this later. Before becoming a real estate developer, Olaide worked in various senior executive roles in the asset management industry and in investment banking. Welcome, Olaide. I would also like to welcome Jubril Enakele, who is the CEO of Ion Capital Partners, which is an African-based and focused investment banking firm. Prior to this, Jubril was the MD CEO of Quantum Zenith Capital, and before that, he had held senior management roles in international investment banks, including Deutsche Bank, Standard Bank, and Citibank. And Ion Capital has been executing several advisory mandates for sub-sovereigns with large property holdings. Welcome, Jubril. I'd also like to welcome Paul Onwuanibe, who is the Group CEO of the Landmark Group. Paul has 30 years of deep international experience in development. He's an expert in commercial property and workplace management, and led Landmark Group's expansion into America, Europe, and Africa. And he's grown Landmark into a significant player in the commercial real estate industry in Nigeria. I think we're all familiar with the mixed-use Landmark Village development, and also with Paul's live, work, and play philosophy. And we have seen the transformative effect of that project on that node, that part of town. Welcome, Paul. And I also like to introduce Mr. Femi Williams, who is the Managing Director of Willao Nigeria Limited. I think many of us will be familiar with the very successful Campbell Center, which has become a landmark and a key fixture of regeneration in Lagos Island. I think many people who would not normally be in that part of town on the weekend have started to go there again. He's an architect and developer and one of the founding partners of Consultants Collaborative Partnership, which started off as Cliff Consultants. He's been involved in many landmark projects for Mark and May Limited, as well as for Airline Services Limited, among many others. Welcome, Mr. Williams. So I'm going to go right into some of the questions we have. I'll be asking questions to all the panelists, and I think we'll have some time to engage in a Q&A session afterwards. Let me start with Laide. So Laide, I mean, COVID-19 has had a profound effect on economic activity, both for individuals and corporates. Can you share some thoughts about how it's impacted the commercial real estate industry and how it has also impacted development activity?
All right, thank you, Lanre. Thank you for the introduction and thank you for the question. Yeah, COVID-19, I think we all didn't have a crystal ball from 2019 coming into 2020 that we're going to spend about 3-4 months at home and just purely hoping to God that everything works out perfectly well. So definitely the Q2 numbers on the GDP as disclosed by the Bureau of Statistics is clearly one that has showed us how devastating the effect has been, minus 17% year-on-year on real estate, and about minus 32% on construction, minus 6% on GDP, and clearly, it's much better than some other jurisdictions that I've seen the numbers, but the effect on commercial real estate has definitely not been left out. I mean, for one, for us at Purple Maryland, and we've seen, given the nature of our development, which some sort of workshop, which has similar philosophy as Landmark, we've been able to have a turnaround from where we were between the months of April and May into a better turnaround by the time we're getting to the end of August, which is about now. We've seen that the devastating effect during those months was purely very high because trading levels, even though occupancy levels were there, trading levels were much lower compressed to just purely pharmaceuticals and perhaps groceries and maybe the banking space. And over time we've seen a gradual improvement in trading levels, and right now I think we're at the final point where the entertainment sector needs to be now opened, and I understand there should be an announcement over this weekend or so for cinemas and family entertainment areas to open. So we've seen a gradual improvement on the retail side, retail entertainment side of things. Groceries has obviously continued to flow. If you look at groceries in itself, the footfall into grocery stores has probably been slightly lower, but the volumes have been higher, with people obviously stockpiling goods into their various homes during that period. So those trading levels have sort of been good for them. So there are different sectors if you look at it when it comes to commercial. So when you say commercial, there's the retail, the office, the family entertainment and cinemas, and all of those sort of come together to play. But what has definitely been very interesting and impressive for us is the fact that when you have a good tenant mix and a good mix of workshop, eat, play, and possibly leave, which is what we're trying to do in our Purple Lekki development now, you then start to see that your recovery point and your quick recovery period becomes quicker and faster. Of course, Nigeria is suffering from a mixture of both COVID-19 effects and also the FX devaluation effects. So, but the question is centered around COVID-19. So it has had different impacts on various sectors of commercial real estate, but we have had given the nature of our developments, which are smaller builds, which are smaller cuts on the retail side, which are mixed-use assets, I think we've done fairly well. Occupancy levels are back up to about, occupancy levels have actually increased to about 98% in terms of occupancy. Our trading levels are still at about 85-90%, given that the last bit, which is the entertainment and family centers, need to come back onto life on stream. So I think concept-wise, if your concept works during this sort of period, then it should if your concept worked during the 2016 January to June period when the exchange rate was all over the place, it should definitely work post-COVID. Yes, spending powers are much lower. So we need to look at, we need to ensure that our lives, the way we conceptualize buildings and developments have to really be based on lifestyle research and work that has been done regarding the situate, where you want to situate the asset in itself and how you want to situate them, the price points that you want to situate them. So we think that going after COVID, there should still be a bounce back. We're seeing more interest and more people asking for space, both in Lekki and Maryland. The type of people asking for, the types of businesses asking for space is slightly different from where we were pre-COVID. I mean, we are now seeing more of the health guys coming out, more of the tech guys coming out. We're seeing, so there have been different sort of effects when you look at the different structure of the commercial real estate space.
Okay. Thank you, Laide. Interesting. And I want to pose the same question to Paul. Laide mentioned that it looks like, you know, if you employ a mixed-use strategy, so live, work, play, as is your philosophy, it's a hedge. But how do you think, you know, COVID-19, or I mean, you've been living it, what kind of effect has it had on the industry? And what do you think it's going to do to development activity?
So I'm on mute. I'm still trying to get the hang of it. It's funny, in real life, you can never get muted. You can only get shouted down. but here you tend to mute yourself. No, thank you. So, I mean, this is a tough one. And you know, Laide said most of the things that I would have liked to say. So great minds think alike, Laide, as they say. You know, but so we've just walked into effectively the biggest health and economic challenge of our generation. And what is required, you know, I believe very much in the cause and effect thing. And what is really required is a real movement, right, to reverse this, or at least to work on it. You know, so I call this thing this pandemic. There are three black swan events that have happened at the same time. So one obviously is the pandemic. The second was the crash in oil prices. And then the third was the lockdown. And those three things have come together to change the way real estate will behave in the future and how it will be accessed. So how does an organization like ours or an industry like ours sort of react to this? So what we've learned from black swan events in the past, whether it's the World War, September 11th, the internet or whatever, we've learned that three things that one has to pay attention to. One is the supply chain, to keep the systems alive and keep things moving. Two is business survival. So there is inherent responsibility, not just on the government and the community, but to ensure that businesses survive, employees remain economically active. And then the third is to ensure that the welfare of the citizens and essential services are provided to those citizens, you know, health, education, you know, utilities, those sorts of things. Now, at Landmark, as you know, over the sort of last maybe 5-7 years, we've sort of evolved from being really a property developer to creating sort of our own unique business environment. You know, we call it a business leisure lifestyle environment. And this has led to us opening various things. So, you know, we have offices, residential, health, educational, retail, sports, F&B, cinemas, obviously the convention center, which most people know, a hotel, a leisure beach, and a number of things within our ecosystem. So, you know, over the years, normally we welcome between 2 and 3 million people a year at Landmark Village. And just to put into perspective the effect of this pandemic, in December, we had 350,000 people that came in. In our business, our currency is footfall. It's not actually the dollar or the naira, it's the people, right? And we had 350,000 people in December. In June, 6 months later, we had 60 people, right? Now, our business preaches people coming together and enjoying all the facilities in one spot. The pandemic preaches social distancing. And that very thing has basically affected the I would say the economic viability of real estate in many different ways. But you know, how do we adapt? I mean, there's several ways to adapt. I mean, and to understand how to adapt, you have to look at the challenges of real estate, and then you also look at the positives. So, you know, I mean, what basically are the basic challenges? The basic challenges we all know, you know, infrastructure, rule of law, unstable economy, title registration, those sorts of things, the regulatory environment. What are the positives? The positives of real estate, I mean, there are more people like Olaide and us, right? So there are a lot more institutional developers coming around. The DIY business is dying off slowly. People are now going to professionals to do this thing. There's a lot of diversification in real estate. And I think the mixed use concept from a future-proof concept should ideally work, because it deals with things like, you know, the infrastructure issues, the security issues. It helps you access things more flexible, cheaper, faster, quicker, more efficient, more economical. So we expect to see a turnaround in things like that, but we have to do a number of things. You know, we have to embrace technology. We have to sort of design with health and safety standards in mind. We have to do our space planning better, so the bigger circulation areas, the entry and exit points of our buildings need to be separated, and we need to understand what this culture of working from home, you know, off screen before the show started, Michael was saying, is he the only one in the office? And I wondered whether he's the only one the pandemic didn't affect. Yeah, but I think that what I am trying to say though is there is a new world, right? And you know, and people say a new norm, but you know, in Nigeria, these new norms go away very quickly. But there really is a new world out there, and how we'll adapt to it, I'm sure as we go through the discussion, we'll talk a lot more about how organizations like ours and others will adapt to it.
Thank you, Paul. Thank you. Yes, I think we will touch on that very soon. We look forward to hearing more about it. I want to move to Mr. Williams. And, you know, I think Olaide and Paul have already started to highlight some of the risks that developers and investors face. And what do you think, Mr. Williams, some of the risks that developers should be cognizant of in the short to medium term are? So what are some of the things they need to think about, consider, and try to mitigate?
Yeah, thank you for all the introductions. Developments and real estate in principle are pretty long term. So I remember ages ago when I started trying to get a loan from a bank, and I went there and I said, I'll need it for 6 months to 1 year. And they said, don't you have anything that is shorter, like 2 weeks or 1 month or 2 or 3 months? So developments are definitely always longer term, which means that we're starting a development now and we expect to finish in 2 years' time. We started Campbell 2016 and we finished in 2019. You know, so you've got to focus on that kind of money, and you've got to focus on that kind of time frame to return that money. So obviously, you're not going to a small finance house which wants their money back in 3 months' time or 6 months' time. You are going to, and that begins to tell you what kind of money you can get, or is better to look for developments. I'm saying things, and then I'll come back to how those things mitigate the risks of development. Obviously, one of the greatest risks of development is developing, and finance costs and other costs begin to take or eat into what you would have called your profit. If you build a property for, let us say, 100 million, and the bank takes 20 million out of it in interest and stuff like that, where is the profit going to? It's like you're working for the bank. So it's very important that you understand that one of the major risks in developments is that because of the time frame, the cost of funds is very critical, that the cost of funds is as low as possible. That can either come from dollar denominating the funds that you are getting, or even getting it in dollars, which would be fantastic, because then the rate is much less, but then you have exchange rate problems as well. Or instead of borrowing at an interest rate that is related to time, try and make the borrowing in terms of equity, which means that people are all in the same boat as you. So whether it takes 2 years or 3 years to finish your business and now start making profits, it's not because of the time. So time, I think, is a huge risk that we all must hedge against. And with time comes issues like interest rates, issues like exchange rates, issues like COVID now met you halfway through and the sites were closed for 3 months. So obviously all your projects are going to be 3 months late. It usually comes back to time as a major risk when you're talking about money and talking about delivery of the projects.
Mm-hmm. Okay, thank you, Mr. Williams. And you raised some interesting points there with respect to the financial risks that developers face. And with that, I mean, I'm going to pivot to Jubril. One of the things that Mr. Williams mentioned was that, look, and I think for some time when things were a bit more stable, there was a preference, given the high cost of debt financing in local currency in Nigeria, to seek dollar funding. So historically, many investment grade projects have been funded in foreign currency. So I guess the question is, my first question to you is that how can developers hedge against this FX risk? Is there any way, are there any instruments they can use to manage FX risk if they've taken on, FX denominated debt in the past?
Is that a question for me?
No, that's for me.
Well, that's for Jubril. That's for
Jubril should answer it because he's the one that has the finance.
He's the money man.
Okay, so let me. I have to be careful the way I answer this question because I understand there is a real need. I understand the need for cheaper funding or cheaper finance, but if your rentals or your receivables are in one currency, Naira for instance, and you borrow in a foreign currency, let's use US dollar, there is already a currency mismatch, which means you are exposing your business to a lot of market volatility. The issue is not just the exchange rate. Say you started at, say, 180 about 3 years ago when Naira was 180 to $1. Today it's, I hear in the markets it's about 474. It depends on who you're asking anyway. That's a significant dip. And it completely changes your business model, if not wiping it out altogether. But that's one problem, the exchange rates risk. You also have a growing problem with exchange control policies that move, creating cross-border risk. So you have your rentals in Naira, you have a dollar obligation. How do you source dollars? Let's assume your business model supports the 474. You have convertibility risk. You also have transferability risk. So my advice is, unless you're getting receivables in the currency you're borrowing, don't do it. Now, for those who have done it already and the ship has sailed, what's the solution? You could always engage a local bank. There are hedging solutions with the local banks, and they can talk you through it. If it's possible to restructure your loan to include a Naira switch or a local currency switch, that would be very helpful. Let me explain how it works. So some of you may say, well, I have revenue, my income is in Naira, but it's pegged to the dollar, right? So even if the dollar is the exchange rate is 500 to 1, I get paid the Naira equivalent of that. That's fine, but how do you find, sometimes converting and transferring the money could be an issue. So how do you match that? In your contract, if you're having a restructuring agreement, you can build that in and say, look, even though your loan to me is $100 million and I'm meant to pay you back in dollars, is it possible for us to have a situation where I have the option of paying you either in dollars or in Naira? You can peg your exchange rate in your contract today, say 500 Naira to $1. So you have the option, and no options are free. So that may actually affect your pricing, but you build it into your model, into your business plan. So you restructure your loan and make it optional for you to pay back in dollars or in Naira at an exchange rate that you agreed today. There's a solution there, but my overall advice in that respect would be, if you can avoid a currency mismatch, please avoid it.
Thank you, Jubril. I would open that up to the panelists. Does anyone have any thoughts? I mean, you guys have to deal with the banks day in, day out in some situations. So, I mean, how easy is it as a developer to work with banks and get this financing? And do restructurings? Are they understanding? Are they helpful? Are they supportive? That's open. I'm not going to force anyone to answer that question.
I think, Larry, I don't know what Paul's recent experiences have been. I mean, from a hands-on practical, for someone that is actively in the market and currently doing all of the exercises that you're talking about. I mean, you said it before, the reason why people go for the dollar-denominated instruments is obviously because they're trying to get cheaper sources of funding, they're trying to get longer-term funding, and that's the only way you can match it with longer-term development, such as commercial real estate. So that puts you in a precarious position because you obviously have to, that's what you need to fund what you need to do. I mean, I think there's still a little bit of gap in terms of understanding, both from the banking sector and also from the pension industry, as to how commercial real estate works and how that should work with the banking system and the pension industry in terms of the investment. I think there still needs a lot of work done. I think our industry, first of all, like Mr. Williams mentioned, wants shorter term investments in a climate where you want longer term development goals. We need to obviously, as the situation manifests itself now, I think more of those players are beginning to see that, you know, presently we don't have the days of treasury bills at double digits in such a way that they can invest just purely in treasury bills and hold positions for profitability, apart from the mark to market that we're now beginning to see on books, on audited accounts of the big banks. I think the banks need to start putting their balance sheet behind sustainable long-term development assets, not just in real estate, but I think it applies across board and not just in oil and gas, as they have typically done in the past. We've also seen that the pension fund industry in itself, I don't know what it is, but maybe there's some level of understanding that needs to be done with them in terms of maybe guidelines, or maybe it's policies, internal policies, or maybe it's just not sufficient understanding from those investment analysts that are going through some of those people. But there's no commercial real estate environment. There's no top grade commercial real estate environment that I've seen that has not grown with the support, domestic support of his pension fund industry, or domestic support of his asset management or banking industry. I mean, if you take a look at South Africa, virtually all of the funding of those developments that you've seen in the last 2-3 decades in South Africa has been done by either the pension fund industry or by the domestic debt market in there. So if you come to Nigeria and you see what has happened, you see that a lot of the development that has taken place in the last decade has been done by the internationals using dollar funding, whether it's on the equity side or whether it's even on the debt side, which shows you there's a clear, I don't know what to call it, whether it's a misunderstanding or just lack of parity or lack of I don't know what it is, but there's something definitely not right. But what obviously as entrepreneurs, and you take risk and you move forward, what we need to do obviously is to try to find a good mix of whatever we have on the domestic scene, because I still strongly believe that the answer to long-term development on the domestic side is not just to continuously look for foreign direct investment, but look for domestic long-term investment. And we definitely have to continue to build and educate those on the investment side, whether it's on the banking industry, and continue to engage them, or whether it's on the pension side, continue to engage them to see how things have done. For on our own side, I think one of the things that we've looked at, we know, I mean, we have targets in terms of where we want our equity to be. We will have targets in terms of where we want our Naira debt funding to be. But one thing that we've introduced into a lot of this mixed use environment is obviously introducing sufficient and significant sales funding into it, which is synonymous to sort of equity funding to augment whatever we're bringing into the balance sheet on the equity side, which is why mixed use in itself, apart from being an edge apart from mixed use being an edge on your leasing and development side of things, is also a good edge on your funding side of things. And we just have to be ingenious. I keep saying to other people around the world that I know that are in business, that if I was in your economy, I'd probably be doing far more better. I'd be doing better than where I am today, or wherever you are there. Because when you do business in Nigeria, they keep saying that the index keeps saying that the doing business in Nigeria is getting better every day. But as being, and I'm sure Paul knows, being on the street, that the index is one thing, but the practicality of what is happening on the street is another thing. And you have to have a mix and match of the best of both capital structure that works for you from a domestic perspective, given all of the things that you will not be given from the banking and the pension side, and knowing what you want to develop and the vision that you have for the assets you want to build going forward. But you need to mix and match and make sure that you have a good plan. So I'm not sure. I know the answer is in domestic investment. I know that definitely the answer is in domestic investment. You've also seen that the REITs industry, the space, has not done particularly well in terms of returns. Maybe that's part of the reasons why there's a little bit of fear from the from the pension industry. That's also because of the mixture of assets in those REITs. When you compare those REITs to the rest of the world and what REITs actually stand for in terms of commercial real estate. So I mean, there's so much we are.
Thanks, Laide. Yes, absolutely.
And Lanre, is it okay if I respond to that?
Okay, Jubril, please go ahead. Go ahead.
So I hear you, Laide, and I think the other market operators here would agree with you. I have to be careful because I'm not here to give advice, but there are different sides to this problem. I'm not holding brief for the banks. The job of the banks, I know they take a lot of stick, and is it possible that they could do more? Absolutely. But they also have constraints. We've talked about pricing, right?
the cost of funds to the banks as well, in Nigeria at least, quite high. I mean, they've come down considerably over the last, say, 5 to 6 months. But cost of funds in Nigeria is quite high. And that is reflective in the pricing that the banks charge. But that's not the only problem. They also have a tenor problem, right? If you think about how the banks get money, it's from customer deposits mostly, unless they go out to borrow money themselves.
Mm-hmm.
How many people put money in the bank for 10 years or 15 years, right? So if you're looking to fund long-term projects, the banks can be as helpful as they can, but they also have restrictions. Now, this conversation started when I talked about restructuring. If it is not possible to restructure, it is very possible to refinance, especially for large players such as yourselves on this call. It may not work for everyone, but it does work. And there are a lot of investment funds, both international and local, that are looking for homes, for deals in the real estate space, mixed use developments especially. And these, in Nigeria has grown, the banking space, not the banking, the funding space in Nigeria has evolved a lot over the last 3 to 5 years. So no one is just dependent on banks anymore. You have investment funds, infrastructure funds, you have private equity players. You did touch on pension funds, and it is a very important point that you raised. I personally believe you cannot have meaningful, sustainable development in any economy without involving a strong capital markets, be it debt or equity capital markets. It's just not possible. Now, I think there is the opportunity to get pension funds, asset managers, insurance companies, and other players in the financing ecosystem involved, but it has to be under the right structures. The trick here is de-risking the transaction to a point where it is easy for banks and all these other players to come in. And I think with the right structures, it is possible. And to end this, I'll end it with this. We can talk about all of this, but there are 2 critical factors that we require. One, the private sector cannot do it alone. So it is essential that we get government institutions that have been set up for this purpose, whether it's the Family Homes Fund or the NHF, the National Housing Fund, to get involved a lot more in this sector. The second point I was going to, and this is the point I'll end with, there are 2 sides to this. Everyone on this call is talking about the supply side of the value chain. You can have a strong supply side, and if you have a weak demand side, you don't have a deal. Because you can build all the houses you want. If no one can afford it, it becomes a challenge. So we must be able to solve, I know we can't solve the problem on this call, but let's bear in mind that there's a supply side, there's a demand side, and we need to find a way to marry both of them for this to work.
Thank you, Jubril. Mr. Williams, you had a comment? You're on mute, Mr. Williams. Mr. Williams, I'm sorry, you're on mute. Okay.
Am I not? Can you hear me now?
Yes, we can. Please go ahead.
The demand side is also financial. I mean, you go to England and you get a mortgage and they say it's for 25 years. And they tell you that, do you want it to be at a fixed interest rate of 4.5%, or do you want it to be at a flexible rate? And I asked them that if it's at a flexible rate, how can it change? And they said it can change from 4.5% to 4.75%. You know, so the demand side as well has to be helped. People want to buy houses. They want to live in houses. But if they can't afford it, if it is not structured so that they can pay for it over 25 years or 20 years at least, then they won't be able to buy it. So it's both sides, and it still comes back to the banking and the financial sector to help to make things affordable. I mean, I've been in a situation where we've tried to reduce the cost of building flats down to 2 million naira per flat. That was some years back. And yet we couldn't get buyers. We couldn't get off takers because, so it's not a question of the house is costing too much. It's a question of how well can the financing of the house be also arranged so that you build a standard house, it's of good quality, it's of good services and everything like that. And the financial structure is also available so that people can afford it. It's not that everybody, in most of the houses that I have built and sold, they've been bought by bankers or bank-related people.
Thank you, Mr. Williams.
That's wrong.
Yes, and just to Paul, before I know I see you nodding, and I know you want to make a point. We have some questions from the audience, and I want to tell the audience that we will have a Q&A session afterwards. I can see some of the questions are already being addressed in batches, but we will deal with them later. Yeah. So Paul, sorry, Paul, I saw you nodding earlier. You have a.
I know that.
Yes.
Thank you very much. Unlike Jubril, I don't have any restraints to my advice. So I'll say it as it is. I think we're all in danger sometimes, and I like to use platforms like this. I hate to be controversial, but I like to use platforms like this to express my opinion. I think we're all in danger of this single story of where we look inside and we think all the problems are inside. So, sometimes we talk about the banks and, we talk about the supply side, the demand side. Look, the reality here is people need to understand that real estate, right, has a huge impact on the community. At the beginning of this conversation, Lanre, you said, there are plans to build 300,000 homes a year, and people are clapping. There's a 30 million home deficit. So it takes 100 years if you build 300 a year to get there, right? And what happens to the population in 100 years? The importance of real estate sector cannot be overemphasized, as property has a profound influence on health, efficiency, social behavior, satisfaction, education, general welfare, and the community as a whole, right? We have to call out the leadership. We can't continue dancing around this whole thing. I mean, leadership is so important in real estate, because real estate is massive. In terms of employment, in terms of just the built environment, how you improve the built environment. Leadership, there needs to be a mindset shift. We need to adapt to this new normal, we call it. There needs to be authenticity in leadership. There needs to be transparency. There needs to be empathy, and there needs to be logic, right? If we're going to unleash real estate as a catalyst for economic recovery, there are many things that have to be done from a leadership perspective. We need a strong political will. Yes, we need to basically embrace the private sector and start partnering with the private sector properly, right? We need selfless leadership where people look out and say, you know what, I'm doing this for the people and for the community. We need a culture of service where people say, look, this creation of real estate is not just about making developers rich. It's about housing, it's about health, it's about schooling, it's about all the things that governments need to be socially responsible about. We need to unravel this multiplicity of taxes. I mean, it's just a nightmare in this business where you're dealing with taxes all over the place. And I mean, you're wondering where before you put a hole in the ground, you spend 40% of your money. It's outrageous. So we need to sort it out. And we need, in forums like this, we need to hit it head on and talk about it. Why do we have all these taxes? You pay these infrastructure taxes and you don't have no infrastructure. We need to reduce the regulatory tyranny. We need to take back control of our society. And I think if you deal with those things, then real estate becomes less expensive, it becomes more accessible, it becomes cheaper, and then finance becomes easier. There are many ways to finance this thing, but let's not deal with the symptoms of the disease. Let's deal with the actual costs. It's too expensive. If it's cheaper, it's easier to finance.
Thank you.
Expensive, you have a platform.
Thank you so much, Paul. Thank you. And I think I want to move on from this specific part of it. I think a lot of very interesting points. And it seems that, look, we all, the ideas, everyone has a sense of what needs to be done. And I think there are models everywhere that we can adapt adapt from in places that have built, with deeper capital markets, that have built the housing sector. There are many examples. And it seems like, for Nigeria, yes, Nigeria seems to be the public sector seems to be starting to think about some of these things, with the Family Homes Fund, as Jubril mentioned. But, you know, I think part of the commentary coming through, and actually from one of the questions right now, is there are issues with trust, there are issues with quality and delivery. I mean, so there's a whole series of systemic issues that need to be addressed from on both the supply and demand side. And I think we need, you know, we need something for the real estate sector to start to thrash these things out. But anyway, I think the delivery of that is for another time. I want to move on to COVID. And I would like to ask Mr. Williams about how, you know, Mr. Williams, you are an architect, yeah. And you've done design. So how do you think developers, you know, in developing now, in designing property, whether it's commercial real estate or residential, what do you think developers should be thinking about these days? You know, I mean, how can they COVID-proof their development?
Well, if somebody can give me an answer as to how COVID is going to end, then I'll be able to answer that question easier. Okay. But since there's no real answer as to how COVID is going to end or when it's going to re-normalize, I think the trend is just that there's a bit more risk now, and that's the effect on design. There's a bit more risk in developments and speculative developments. Speculative developments, as in the last 5 to 10 years, has been pretty much do a good house, do a good apartment, do a good office block, and you'll get buyers. In a good area. I mean, location is important, but if it's a good quality and whatnot, you would get buyers, and you would get people to rent it, or you would get buyers if you were going to sell. Now you've got to be a bit more careful as to whether there's a tendency or there's a volume for that kind of appetite. Certainly things are changing in terms of rentals. I mean, rentals, there was a time people were offering us 5 years rent in advance, then 3 years rent in advance. Now you are afraid to even ask for 1 year's rent in advance because some people want to pay 6 months. They want to pay 3 months, you know, and it will get to monthly payments. I mean, in England, it is monthly payments. In Dubai, it is, you pay for a year, but you get a good tenant. If you have a good tenant, he'll give you 2 checks. If you have a very good tenant, he might pay for a year, but most of the checks are 2 checks for a whole year. So it's getting to a point where the financial system and you as a developer have to start thinking of smaller bites. You're not going to get all your money for your development in the first year or second year or third year. It might take 5 years or 10 years. And that's what I kept on saying before, that the money therefore has to be longer term so that it can afford a longer payback period. But you still make a profit. But certainly COVID has affected the idea of having more speculative developments. So your developments are more particular to this kind of trend. 1-bedroom flats are going faster and better. Smaller flats are going better. And also maybe a tendency to start looking at when you're actually doing commercial developments, you look at the commercialness of the development. And by that, I mean developers, at least we are thinking more about how do we get into the businesses that are actually in the buildings, not just looking at the rentals that can come from a building. And I think it's the same case with a lot of shopping malls. You will find that people that develop shopping malls actually have an interest in some of the businesses that are in that shopping mall because they can't pay for the shopping mall just by renting out shops again. They can't also pay for, you know, office blocks just by renting out office blocks. They have a part in either the restaurant that is in that office block or one of the businesses that is in that office block. I'm sure Olaide might have some sort of opinion on that as well, but I think that's the way developers are going now, rather than just, because actually if you look at it, a business should not spend more than about 10, maybe as much as up to 15% on its rent. So if I build a property for you and I know what you are going to do inside the property, let's all share this money now. Why do I have to only get 10% of your money? You know, so that's the way the developments I think are going as well.
Thank you, Mr. Williams, and thank you for directing it to Laide, because that was, you know, I was going that way as well. Which is that, I mean, and this is, I'll start with Laide and then go to Paul on this, which is that, okay, so how are you responding? I mean, for instance, how are Purple and Landmark looking to drive footfall back into your malls to enjoy your leisure facilities? I mean, Landmark, you are an investor in office space. You know, what kind of corporate reentry strategies are you seeing, and how are you managing to deal with that? So, and I have a follow-up question, which is on the flexible space market, what your thoughts are on that. But Laide, let me start with you, since Mr. Williams passed the ball in your court.
Yeah, so thanks, Larry. Thanks, Mr. Williams. For us at Purple Maryland, for example, right before there was any sound of COVID in Lagos, we had installed. We immediately, once we knew it was coming our way, we had installed all our washing basins, put in place all the temperature checks at the entrance. But we had not started implementing the use of masks as far back as mid to early February when we started. Of course, by March it was all over the place. So we obviously knew that health and safety was paramount and important going forward. Something that at Purple Maryland we had always had in place in terms of our maintenance cultures and the health and safety culture that we needed to put in, that we needed to have in place. We had to step it up, and I believe just after COVID, I also went into the Landmark building just to spy on Paul. And one of the things that I saw that they had done, which was good, and which we had done in a slightly different way, was that, you know, when you go into their lift, you have to the lift. You have to go. There were only 4 people in the lift, and you have to stay in your corners and face the. And I thought, well, Paul, that's a bit extreme, but but you know, at that point in time, there was so much. The nerves were high. Everybody was all over the place, and right from the top of Landmark building, you could see the COVID-19 center, right, the luxurious one facing the Atlantic, and you know, but you could feel the pressure of making sure that health and safety is taken as number one. For us at Purple Maryland, we've obviously also put in place the culture of ensuring that we sanitize and continuously sanitize during the day, and also a full-blown sanitization also going into the tenant and other office spaces to ensure that we have a full cover in terms of disinfecting the entire area, because these are public places, right? And people will keep coming in and going out. I mean, we saw our footfall drop to as low as 500, 300 human beings a day when we were typically at about 4,000, 4,500 a day. Right now, our trading levels are 85%. We are back up to about 60, 65%. And we did of our normal footfall in a single day, and we know that once the entertainment and cinema comes back into place, that comes into play. But health and safety is playing a major key role in all of this, and as we put the cinemas into play as well, we also need to ensure that health and safety within those cinema spaces, which are more bigger communal spaces, are also they are also well taken care of, and ensure that, you know, we at least stem the growth or the growth of COVID in our environment. And beyond COVID, there are also other ailments around that, you know, all of this also helps to, that we've previously overlooked, help us to try and curtail.
Thanks.
So we know that health and safety is key and paramount. You know, our air conditioning system and how they're located and where they're located and how the flow is are very key for us. Technology wise, also key. And we've seen a gradual improvement. And surprisingly, at the last Muslim holiday break, we did in a single day we did close to about 9,000 visitors in that day. I mean, typically it would be higher, but that shows you that, you know, when we talk about spending power and people wanting to come out to play, human beings are a different species. They despite all of the health and health issues around, people still want to come out and do certain things. And we've seen our traffic flow on normal days going back to about 65%, and we expect it going into September, October to go back to at least 100%, and probably even no more, because the demand that we're seeing and the responses that we're getting regarding the cinemas opening almost wants us to believe that there may even be a surge in cinema attendance, even though, especially, you know, there's something about human beings. What you're taking away from them is what they actually want more of. You know, you're curtailing the sitting to 50%, but these guys are saying they want to take more seats in cinema halls. So, you know, we're looking at all of those things. And if you go back to Populeki, which is our new development that we're currently piling on and moving strongly on, we've seen domestic players coming out in strong forms, you know. We've heard about ShopRite trying to pull out of the environment. We've seen a slow pace of growth from Game. We've seen all the other guys, but then the domestic guys are coming out with in the strongest form I've ever seen. It's alarming. Is that we actually obviously knew these players were there, but in some funny way they were ignored and set aside, either by us as developers or by the major leasing consultants, or by sheer definition that, oh, international was better, was why we all went and felt that we were more secured with the internationals than. And if you look at us at Purple Maryland, we've always had the higher percentage of domestic to internationals when you compare it to the larger centers. And when you look at it now for Populeki, well, before we even move to site, on our retail entertainment floors alone and co-working space, we had 60-65% occupancy signed up to. I remember we were in the market for a bond issue, and everyone kept on saying, oh, with COVID, this is not going to be reaffirmed. We've actually now seen can I call this post-COVID? We've seen an increment. We've signed eye clinics. We've signed all of our food spaces are all gone. We are still at piling. You know, we have not even 50% at piling. All of our food space is gone. The cinema is gone. The major groceries, the cinema is Genesis Cinemas, and the major grocer that is working with us is Market Square, which is a South based grocery store with multiple locations in the South. And they've come back to actually try to increase their space from what they had initially approved by another 30%. And you know, we've seen tenants like MedPlus signing off. We've seen the domestic electronic guys signing up. Our occupancy level on the ground floor is pretty much done, apart from the banking spaces which we're trying to sort out, and all of the concession stands. Because the way we've designed and we've built is also something you need to look at. You need to see that what you're giving to these people are not such big cuts of 150 to 250 square meters. No, you're bringing them and cutting them into smaller sizes that allows them to be able to, that is modular enough for them to be able to expand if they have to, or if they need more space. So you need to be looking at all of those things. The pricing points and all of those things then come into effect. And that's why we're saying, and if you look at mixed use nature, when you now go up to the most important floor, which is what accounts for at least 60% of what this Populeki development is actually a short and long-term stays, which are a mixture of residential and hospitality developments, of which we're selling. Our intention initially was to sell a portion that would give us about a 2.7 billion in revenue flows, right? We've exhausted that sale. And these are going back to what Mr. Femi Williams said about single studio apartments and one bedroom apartment and modular structures of buildings. We need to now go down to the basis and look at lifestyle and what people want. And that is what we are positioning ourselves to be, a lifestyle development firm that gives them a mix of what they would aspire and would want to invest in and want to hold in their portfolio. We wanted to sell a portion to about 2.7 billion. We've now been able to expand that, and we are now at about 3.3 billion in terms of sales. We're still at piling. Our target point is still probably about 1.5 billion off. But it just shows you quite clearly in terms of commitments and willingness, and the fact that is the money in the system from domestic players? The answer is yes. Do we have the right products we're giving to them? The answer is that we need to start thinking in that direction, and we need to start giving them products in that direction that allows them to bring out those funds and invest in their domestic environment rather than shipping them out into dollar instruments or dollar assets across the shores of Nigeria.
Thank you so much, Laide. Thank you for that. And Jubril, sorry, I'm taking that question to Paul now, but I'm going to come back to you again on this matter of possible potential structures for financing real estate. So going forward, I'm going to be asking you what your what is the ideal way to look at financing real estate given the current environment and given the structural issues that we have now. So there's still issues, but what are some of the ideal ways? I mean, Lydia has mentioned that obviously pre-sales are a big part of financing that. We've talked about, Mr. Williams talked about debt with equity kind of characteristics. So I'm going to be coming back to you to ask you how you think developers, what kind of financing can they look to tap for their projects going forward? But before I do that, Paul, so the same question to you, really, how are you driving footfall back into Landmark? You have Landmark Boulevard launched. You have the entire development. How are you driving footfall back in there?
Well, thank you. And just to say, I'll be looking forward to listening attentively to Jubril's funding options. So, this COVID-19 pandemic, it's obviously changed the trends in real estate. It's introduced new trends. There'll be new norms, as we say. There are new approaches to doing things. And post-COVID, this sector will not be left out of the change. I think the changes will continue even post-COVID. Laide has already hinted that during this COVID, our business more or less came to a standstill because of the mixed-use nature of it and the leisure and entertainment nature. So we decided to embrace society or the community, if you like, and play a part in creating our own isolation center. We had it there for three months, and we've taken it down now, and for the simple reason that it was not necessarily compatible as we begin to open up our services again. During the sort of 4-month standstill, there are a number of things that we did. Those on a strategic basis, those on a tactical basis, and those on an operational basis. So on a strategic basis, we decided that there were a number of things we had to do. We needed to embrace technology more in our business. And anybody who comes to Landmark over the next sort of 2 or 3 months will see that we've embraced technology. We've tried to digitize a lot of services. So whether it's access to our hotel or the beach or the convention center or even the restaurants, we have what we call a Landmark Citizen or Landmark online platform, that enables you to enjoy our services without actually coming to the location. So hopefully that will create some differences. The second thing we've tried to do, and more on a strategic basis, we tried to build on our brand on just basically the authenticity and the transparency of it. So we did what I call the 4 C's. We engaged with our customers, we engaged with our consumers and our staff, and we looked at our cash flows and our credit lines, and we communicated with all our stakeholders. And basically we did this throughout the sort of 4 or 5 month period just to ensure that we were in touch. Now we understand that, and I know you're probably going to talk a little bit more about this later, sort of the whole landlord-tenant relationship issue, how all the tenants come back and say, look, you need to help us. But there's a chain here, right? And the chain starts with the government need to help the companies need to help the tenants need to help the consumers. And anybody who breaks that chain, at the end of the day, the consumers suffer, right? So we recognize, and with the right amount of empathy and logic, there's give and take. And although we're no good to the tenants if we're bankrupt. But what we have tried to do is we've basically tried to work through that chain and create some rebates and create some additional services that will help people. As they say, look, there are no roses without thorns. In order to enjoy something that's beautiful and pleasurable. You must endure the difficult and the painful. So we'll go through a bit of that pain to ensure that the tenant survives and thrives. Just generally in our mixed-use environment, again, Olaide has said, we've put up signs. We've tried to make sure that there's more social distancing. In terms of designs, we've tried to increase our spaces as well, some of our exit and entry points. We've tried to make a lot of things more contactless, so you don't have to touch doors and lift buttons and things like that. They open automatically. We've tried to segregate a little bit more. We've tried more sustainability. So even with our power and stuff, we've moved a lot more to solar systems and to gas powering. And so that has helped with the value chain and the contact points along the system. So there are a number of things. The other thing we have tried to do is literally just embrace this whole technology of working from home. So a number of our team don't come to the office. Many do come to the office, but many don't. So there are a number of things that we've tried to do to make the office the home and the home the office. And because we're trying to embody this whole mixed use theory, we've had to bring that closer together.
Thank you, Paul. Thank you. And I want to take something before we go back to Jubril. Sorry, Jubril, you still have a little time. I'm going to touch on something else very briefly. Paul, you mentioned that, like, look, in terms of support, there's a chain, and possibly that chain starts with the government. And, as part of the stimulus packages we're seeing globally, in the UK, for instance, you have something called Eat Out to Help Out, where the government is subsidizing meals out, trying to get consumers back into restaurants. I think, in Nigeria, as part of the economic sustainability plan, there's payroll support as well as part of that package. I mean, so I guess my question is, and Mr. Williams, I would like to direct this to you. The government is doing what they are doing, but do you have any suggestions for how to stimulate consumers? How to get spending back up? Are there any things that they could be doing? I mean, obviously, our financial system is not as developed as in some of these other markets, and you have to be very careful how you direct stimulus. But what kind of ideas do you have in terms of, encouraging consumers to go out and start to enjoy leisure again, start to shop again, getting consumer confidence back up?
Well, that's a difficult question, and I feel government has to help in terms of maybe ways in which they can make business easier, and really begin to see how they can help businesses. It all boils down to things like better infrastructure, and issues like that. But in terms of immediate and quick fixes, like you get in England, where you can go out and eat and pay half, and the government pays another half, that's a bit risky in this environment. but I can't think of anything that is short term that can easily be done by government. There are more long-term issues, like the real problems you have with getting approvals and stuff from Lagos State and so on and so forth. And since I'm trying to get some, I don't want to speak too aggressively against them. But you know what I mean. Things could be easier. There could be easier ways of doing business, and I don't think they are really sincere about that yet, because we have an office in Rwanda, and we know how easy it is. You don't even have to go. They actually tell you that you have paid more tax, and they can return some of the tax that you have paid. I mean, that will never happen here yet. So maybe somebody else can suggest the quick wins that government can make.
Well, I can think of a couple of quick wins. that are sort of less strategic and more short term. So the government and the people, so let's say the government, the people and the businesses have created a pipe, and there's a bond between everybody. And that pipe, the government calls it tax. They created a tax pipeline, and you dig it into organizations and you say, pay your taxes, right? That same pipeline, you can use it to give away palliatives. Right, so you can basically say what you need to do in a pandemic at a time like this is to ensure that people are economically active, so the world keeps on going around. So you send back through that pipeline to ensure that people are not laid off and people are paid their salaries and people use this money out in the community. Yeah. And you send it back through the tax pipeline, right? And you just make sure all the people who pay taxes get some money back that they can spend. I think that's a direct and a very easy and quick way that the government can keep the economic cycle burning.
That's a good idea.
Thank you. Thank you, Mr. Williams. Okay, Jubril, we're all waiting with bated breath to hear how we can get in this industry long-term, reasonable cost financing. Over to you.
I feel like I'm being set up here. Okay, so
the cap that you're wearing, that's why.
I'd like to approach this from two perspectives. I think Paul mentioned that we have a gap of about 13 million houses. It doesn't matter what the three of us are doing on this call or whatever we're doing in Lagos. How many homes are we going to build? 1 million? 1.5, 2? That's even at best. Let's think about a holistic solution for the entire country. Not just us in Lagos, those in Sokoto, in Maiduguri, in Cross River, in rivers, in Delta. Let's think about a holistic solution. How do we solve the problem for 13 million homes? So that's what I want to address first. And then we now come down to the individual financing solutions for respective developers. Now I am of the firm belief that we can build our way out of economic contraction or a recession. But we need all stakeholders. So let's start with the 30 million home deficit problem. Today, the government owns, and this is not just the federal government, state governments, the government owns the largest land bank in the country, right? Land essentially belongs to the government, either directly or through their different agencies or parastatals, but the government owns the land. One of the biggest challenges for people, as Mr. Williams talked about earlier, location. One of the biggest challenges is also getting land. And we have regulatory issues, we have license issues, yes, but land is a big challenge. Let's assume we're able to have a solution, and I'm talking about the 30 million deficit. I'm talking about the holistic first, right? We had a solution where the government, through its agencies, whether it's the National Housing Fund or through the Family Homes Fund or any of such vehicles, it could even be through an agency like InfraCredit, which is an agency of the Nigeria Sovereign Investment Authority. Let's assume we're able to structure some form of credit enhancement. Come up with a structure. It's all in the structuring. I believe there are no bad deals, just bad structures, right? So let's assume we have the structure that works, that provides credit enhancements on the supply side, that allows developers access funding on the back of those credit enhancements. Long-term funding. Today, it's difficult for a pension fund to come into some of these structures because, look, you're playing with people's retirement money, right? And it's quite risky because there are other issues on the demand side. If we're able to come up with a structure that allows, let's deal with the supply issue first, that allows the pension funds bring in long-term money and other capital markets players, whether it's the asset management companies, the insurance companies, possibly the banks, come into a situation where you can raise 20, 25-year money, 20, 25-year patient money on the back of some credit enhancement, which is properly structured. It helps a great deal in solving that problem because developers, so long as they tick the boxes, can access it, and not access it just for themselves, but in line with what the government is trying. Let me give you an example. Say the government, we are able to put together a credit enhancement paper that allows developers build homes in Borno, in Sokoto, in Kano, coming down to Plateau states. Then you're doing it in Kwara, you're doing it in Ogun, Ondo, Cross River, Akwa Ibom, River State, Bayelsa. They won't all be the same structures, but you can easily create the multiplier effect of that development will be across the entire country. You could easily build your way out of a recession with the right structures on the supply side. Now let's turn to the demand side. On the demand side, the biggest problem, as Mr. Williams talked about, is affordability. People are unable to afford quality homes without mortgages. We have the Federal Mortgage Bank, and there are other institutions. We have mortgage companies, primary mortgage companies, and other players in that space. How do we unlock the capital, make it easier, a lot more transparent, a lot simpler for someone who earns 100,000 naira a month, which is 100,000 naira, say 100,000 naira a year. Let's even bring it down to basics, right? 100,000 naira a year. Typically, you're not meant to have, your property is not meant to be, accommodation is not meant to be about more than 30% of your cost, right? So that's 30,000. Over 20 years, or 25, say 20 years, that's 600,000 naira. How do we get a 600,000 naira mortgage for someone to be able to buy a home, right? And the developers will need to think about structures other than concrete, brick and mortar, right? Maybe outbuildings, shipping containers, it could be pallet homes, whatever it is, right? There's technology, enough technology to be able to provide houses in that bracket, right? But if we're able to unlock the demand side based on current structures, I'm not saying we should reinvent anything at the federal or state or at the center. It's just bringing the right stakeholders and the right financial advisors into the situation that structure those kind of things. So I would like to solve a holistic problem for 30 million people than just a problem for 5, 6, 10 developers. But let's even turn to the developers now. We've talked about the banks. The banks are the traditional source of funding for most developers here. But the market is evolving. There are more players coming into the market that we could access. We have, as I mentioned before, infrastructure funds. There are now private equity players who can come in, but they come in with a combination of both debt and equity in some cases, not just equity. There could be debt, it could be equity, and everything in between, whether MES, convertibles, whatever it is. That market is opening up, and it's a lot more patient. Maybe with the private equity players, you're looking at more like 5 to 7, max 10 years. But the infrastructure funds are able to wait it out for 10, 15 years. In some cases, maybe even longer. We have local development finance institutions. Let me not use the word local, I'm sorry. Regional development financial institutions that are able to come into these situations now because it's infrastructure. There's also a source of funding that a lot of people surprisingly here do not, sorry, that came out wrong. A source of funding that people typically do not turn to for whatever reasons. And it's the Sharia compliant financing solutions. And embedded in the Sharia compliant financing solutions, Sharia compliant financing is not about religion. It's not a religious conversation. It's about funding structures that allow people acquire assets. They have those structures already built in. I find a lot of developers it's not top of mind when they're thinking about acquiring assets to go to some of these Sharia compliant institutions. And we have a few of them as banks in Nigeria as well, right? So I think there are pockets of funding that can be unlocked. I feel the resources are here. It's how we structure it, whether it's through the pension funds or banks or some of these other funding sources, that makes the difference. I'll close with this. I think it is going to be extremely difficult, almost impossible to solve this problem without having all critical stakeholders involved. And one of the most important stakeholders in this respect is the government. Does that help?
That's good closure.
Thank you.
Thank you, Jubril. Thank you for that. That's a few very interesting insights for all of us here. And we hope that we can get that holistic solution going. Okay, a few comments from the audience. I think you can see it. Mr. Wale Agbeyangi says that for the real estate sector to grow, operators have to push for regulation. The sector must be regulated by a well-regulated body to remove charlatans and encourage investors. CBN for banks, SEC for capital markets, PENCOM for pension funds. So I think, I mean, this is kind of speaking to what we are all saying, which is that all the key stakeholders need to be involved, from the public sector with reputable private sector participants, so that we can create long-term viable solutions for the industry. So what I'm going to move to some of the questions from the audience now, before coming back to some final questions from me. The first question, actually, there was a raised hand from Lanre Masha. So I don't know how we can get, I don't know if one of these is his question. Is there a way to hear from Lanre Masha? Okay. Okay, yes. Can you help us with that?
Yes, okay. I can speak now.
Okay, Lanre Masha is there. Okay, please, Lanre, do you want to go ahead with your question? Okay, perhaps while we're waiting for Lanre to give his question, we have a question from Olusegun Adenekon, who asks, how can startups or new platforms survive this era? We need your advice. So any thoughts from anyone on how startups, I'm guessing these are either real estate development startups. So what can they do to survive in this period? Anyone have any quick ideas for Mr. Adenekon?
Well, I would say, I'll say, so the issue is not just survival, but it's how to thrive after it. And I think one of the key things to do is be deliberate about your thought process, be deliberate about your strategy. Think of not just the time now, but the time after. You know, one of the things that natural disasters have taught us is that during the natural disaster, you can't really think as clearly as you can afterwards, because the effects of that natural disaster usually happen 6 to 12 months after. So, you know, real estate's a long ball game. So think of it as a long ball and use long-term instruments to ensure that it's sustainable and it's future-proof.
Thank you, Paul. Lanre Masha, are you on now? Are you able to? Hello? You want to ask your question?
Hear me.
Please go ahead. Okay, I think we've lost him. Okay, there's a question from Elizabeth Sage, who says, can we talk about financing real estate buyers? how can you work with the NHF and FMBN to ensure mass housing can get purchased? And I think we've answered that already, which is that we need a holistic solution to providing mortgages for the demand side. Okay. And a question from Richard Akerele, which says, does the panel feel that COVID was really just a catalyst to change through technology? Working from home, online shopping, ATM machines, solar energy, internet, home entertainment, and AI. So I think what the question is asking is that, what does this new normal mean for technology and for, what does this new normal mean for real estate development? I think that's the point of this, that the question is, is COVID just a catalyst for the change we can expect to see in technology and development? Does anyone, actually, I might direct that at Paul, because Paul, you talked about technology quite a bit. So do you understand the question, or should I try to state it again?
No, I think I understand the question, and Richard can decide whether I've answered it properly. So mine is just is a view. So I think technology plays a huge role, and yes, I agree with you, Richard, because that's more of a statement that COVID has acted as a catalyst to bring technology into the domain. And one thing the real estate industry hasn't really done over time is embrace technology and new systems. So it's forced us to do that. From the demand side, it's forced us to look at technology as a way of reviewing real estate and choosing real estate. From the supply side, it's forced us to look at it in terms of creating real estate. From the finance side as well, it's forced us to look at it in terms of opportunities of financing real estate. So technology, I think, has a huge impact. And which brings me on to sort of what would happen to the real estate sectors post-COVID. And maybe something, again, Lanre, you may be talking about later. I do believe that there's a big space, and hopefully this answers or helps the previous question. There's a big space in the real estate sector in Nigeria for technology-induced real estate. And what I mean by that is, working in this, look at the industries that have done better because of COVID, right? That COVID has been a catalyst for. So, the logistics industry, so whether it's warehouse or transport infrastructure, technology space, and when looking at homes as well, how you deal with your homes in terms of technology too, working from home and increasing your technology content to enable you to work effectively and efficiently from home. So I agree entirely that it's a welcome addition to the real estate repertoire.
Thank you, Paul.
Larry, if I just add to that short point, yes, technology for us, the things that we're looking at is how do we bring in the fusion between that technology, as people ordinarily know it, and brick and mortar, right? And obviously, with COVID and all of what has happened, has sort of fast-tracked all of the future plans to the present plans, and trying to bring together, what is already existing in other parts of the world in terms of the online marketplace, and bring it out together with your existing brick and mortar structures. For us, we're launching our Purple.shop marketplace shortly. Any moment from now, we should be able to do that, and that's obviously fusing all of our marketing, all of our products within our brick and mortar space into an online marketplace that we can make available to not just our footfall customers, but beyond our footfall customers, for growth of our existing pool of tenants and players. So technology, as we know it, will definitely play a major role in how we move forward. But then we also need to be mindful of at what point, where are we in Nigeria or in Africa as to how technology should play. We need to adapt it slightly. Not everything that works everywhere else in the West works exactly the same way as it works in Africa or in Nigeria, we have to adapt it slightly differently and ensure that we're taking it in the right direction. So yeah, I just wanted to add that to what Paul had mentioned.
Thank you, Olaide. So now I'm going to ask a few questions in closing. Most of them will to do with the future of the industry. But before that, I wanted to ask more about the landlord and tenant relationship going forward. We've kind of touched on it at different parts of the conversation. So I'm going to ask three of you as developers and Jubril as an occupier about how he's going to be using real estate going forward. But let me start with Mr. Williams. So the question is, what is the future for the landlord and tenant relationship now? I mean, we have COVID-19 has effectively led to a big structural change as things are. So what are some of your thoughts on what landlords should be, you know, how landlords should be approaching tenants? One of the things you said earlier was that, payment terms are changing. You could pay, you know, as a landlord, you could demand multi-year rents before, now it's shorter.
Well, I think the roles are changing rapidly. You know, in shopping and whatnot, you say the client is king. Well, I think the tenant is now becoming king, and landlords have to react to tenancy. And I think that's a good thing, actually. It's not, I'm a landlord, but it's still a good thing that you have to react to what the tenant requires. In my father's time, it was take the building as it is. And, you know, he got tenants. But now I think you have to be more adaptable. You have to provide more things. You have to provide white goods. And very soon we're going to start having furnished apartments being more popular because we're all living a faster and more mobile life. So we don't want to have to carry around so many things when you're moving from one house to the next. So certainly the trend is that you are adapting more to what the tenant wants. And I think that will give you better housing, better accommodation. Eventually it will be cheaper as well. And the landlord just has to be more adaptable. In Dubai, they have things like, you know, the tenant is charged for a year, an annual rent, but he actually gets 13 months. And I asked the agents that, why is it 13 months? They said that's just to encourage the tenant. So you're going to start getting 3 months as well for tenants, just to encourage them to take the place, you know. So it's certainly moving in that direction. And also in serviced apartments, you're going to start getting landlords taking care of things that would normally have been a tenant responsibility. Like for instance, landlords would have to take care of air conditioners that have gone bad. Landlords would have to take care of course, generators that are going bad or that have to be set. Of course, that is constant. But the replacement of these things as well. Sometimes you have to have an asset, like a sinking fund or an asset replacement fund. But if that is beginning to impact on the rental value or the total that the tenant pays, sometimes some of those factors will start having to be borne by the landlord. And that's what we are finding. And I think we just have to live with it.
Thank you, Mr. Williams. I think, so for Olaide and Paul, given what Mr. Williams has said, I mean, you're effectively in a situation where tenants would expect more from you. So, I mean, that's compressing your margins. You probably have to be a lot more creative in what, you know, how you approach your occupiers now. But so the question, I guess, to both of you is that, how do you benefit from the upside? Now, you know, we're in the down cycle. Tenants are asking for more. Are there ways you can benefit to the upside? I mean, beyond waiting for a lease to end and then trying to increase your rent, which is always very difficult. I mean, so should we be expecting, at least on the retail side, for instance, more things like turnover rents? Is there any way you can convince your tenants to, you try to participate in a recovery, for instance? So just, I mean, some questions.
I think absolutely, and the tenant landlord relationship is actually a partnership. It's not a master and servant relationship, and I think it's important for landlords to realize that, and also important for tenants to realize that. So apart from the things that Femi has spoken about in terms of reduced rent rebates and probably reducing operational costs, so reducing service charges and stuff, one has to look at how the tenant and the landlord can partner together for something longer term. Real estate is a long-term game, so you don't have to make all your money in 1 year, 5 years, or even 10 years, right? And I think that's the first realization. Once we realize that we're in a long ball game, then we can spread it. So for instance, I'll be talking to tenants about stay longer and I make it cheaper, right? Those tenants who are cash rich, and remember, some industries have heavily profited from COVID. Like the pharmaceutical industries, the logistics industries, the technology industries, and many of them have a lot of cash in their hands. So some of them have been able to pay advance rents at the time that you need it, yes, to significant values for you to reduce your debt, whether foreign or local. So there are quite a few ways that this partnership can work, but communication is very important to understand what the tenant's problem is and to understand what the landlord's problems are. And in most of our developments, our developments are anchor-led. So we've built our properties for specific organizations. So they've always been long-term plays. And I think it's important to remember that relationship is something that one has to always work through, even though there are unexpected surprises.
Thank you, Paul. Olaide.
Sorry, I was on mute. I don't think there's anything new in the approach or in the way new per se in the approach of the way things will go going forward. I mean, in the past we've had both a combination of bulk payments in terms of advance payments for leases. In the past we've had a combination of monthly, quarterly payments on leases. In the past we've had Naira payments on leases. We've had dollar payments on leases. So I mean, I think everything is now coming to a situation where you're not trying to take a decision as to what is the actual way forward. And for us, because we're in a partnership business with our tenants, we are flexible, we are open, we're continuously in discussion like we have always been, and we'll continue to be in discussion with them. We've seen more crave for Naira type leases with Naira escalation, which means that those escalations are now tending more closer to the double digits, late teens, and we're seeing all of those things. We're seeing those that have been maintaining on the dollar side, also trying to have negotiations on where the exchange rate, which is essentially more on Naira leases. We've seen a lot of grants granted for periods for downtimes, and as things begin to pick up, we're seeing them coming back to trades and a full velocity and full venom. And so we've treated our tenants as partners prior to COVID, and even after COVID, we're going to see all of that. So there'll be talk around that. We'll continue to talk around new leases that look at escalation rates, that look at whether they're dollar or Naira leases, that look at the methodology of payments, whether they are bulk payments or monthly or quarterly payments. And I think the more we now look more towards our domestic players, we need to obviously, as property owners or property managers, to begin to structure these leases in terms that allow for more domestic participation. And what we tend to see is that there are loads of strong domestic players in the Nigerian business environment that can actually partake. And the way we design and conceptualization and how we make those things affordable for them to pay is also important going forward. So we will definitely see some tweaks and turns here and there in how negotiations and discussions go on, but we still expect trades and we still expect occupancies to take place, because as you see a movement away from certain types of tenants, you then see a new set of tenants, even in the office spaces. And I tell people, as they disappear, you then see a new wave in the technology space. You then have a new set of tenants you have to deal with, and that's the beautiful thing about real estate. The fact that once the space is there and is of the standards and the quality that it needs to be of, then you will continuously find a tenant. Now the problem is pricing and how long are you willing to wait out, which is what Paul has said very carefully, that it's a function of time and elasticity, and we need to obviously be able to continuously service our obligations and continue to move forward whilst also take care of our shareholders. So all of that will come to bear in how we move forward and how we use capital structure and how we partner with our tenants. And obviously, even prior to now, like you mentioned, in terms of proportion of revenues and as a combination of tenant leases and rentals with a proportion of revenues, those things have always been in play. We had one of those ones prior to now, and even with the big players, we're also in discussion with some others for that under a split revenue split basis. And there's nothing new. It's just how things will eventually sort of evolve, which means that potentially landlords will take slightly more risk but make more money, and could potentially make more money, because we're used to the past where landlords typically just give spaces but do not even participate in the marketing or the push of those spaces and getting them to levels where the footfalls are strong enough. Now we have to get into a new realm where landlords are seeing themselves strongly as partners and actually forcefully pushing marketing and pushing systems and processes to ensure that sales are all-time high.
Absolutely.
Regularly all through.
Thank you, Laide. Thank you so much. And Jubril, sorry, my question to you is that, as an occupier, how will you be using space going forward? Are you going to be encouraging your team to work from home? Are you planning to reduce the space you have? What are your thoughts?
I think a lot of firms are going to adopt very flexible working spaces. You will find that companies that before used to have 100 people coming to work every day will probably have like a timeshare kind of situation where they go into a much smaller space and then they rotate the number of people that need to come in, especially if they don't need to come every day. I think you're going to see a lot of that happen. But if I may, I'd like to talk about this issue. I want to talk about this from a residential point of view, because everyone has seemed to touch on commercial. Everyone is feeling the pinch, right? Both landlords and tenants. But we seem to forget Nigeria is 200 million people. The kind of people we're talking about that afford the properties that we're all having a conversation about here, 1% or maybe even less. COVID has the entire economic situation, combination of COVID, stay at home, oil prices, has affected a lot of people's ability not to earn, but to survive. So I want to address two cadres of people, those at the top of the market or middle to top, and those at the bottom of the pyramid. Middle to top people who hitherto would afford a place in Banana Island or one of those really nice highbrow areas. If you go around those places today, you have quite a few more empty homes than we did about 5 years ago. They're also downsizing. Those who are able to afford those properties are going to, in terms of tenants I'm talking about, are going to require better payments or better terms from their landlords. So you'll find legal agreements will become smarter. You'll find the smart ones will probably have rent to buy clauses included in their contracts, which as property developers, I think it's a good catch. If you're doing residential, it's something you may want to consider, including rents to buy, give your tenants the option to buy the place after about, say, 5 or 10 years of staying in. But you're going to see a lot of negotiation and changes in that area as well. You're going to find that because of the downturn in the economy, we're going to have, there could be insecurity issues in certain areas. And you're going to find people will migrate or show a preference for gated communities and estates rather than houses that are single, standalone on the street because of that security element to it. People are also going to show a preference for neighborhood watches, right? So I think the prices of homes, residential homes in highbrow areas will come under pressure, right? Whether from a rental point of view or an outright sale point of view, I think that will come under considerable pressure. Now let's go to the bottom of the pyramid. It's hard for us to imagine, but there are people who, there's a lot of rough sleeping that goes on across the country. There are people who sleep and live in shacks. 2 weeks ago, I had someone who I engage quite often come to me saying, because of the closure of the Third Mainland Bridge, he works on the island. He needs to just get a small shack somewhere. It's essentially just wood put together. I'm not joking. It's just wood, right? And it's here on the island, somewhere on the island. It's not like it's somewhere on the mainland, in Lagos on the island. And the rent had gone up from 100,000 to 120,000. I think people at the bottom of the pyramid would find that real estate or cost of accommodation for them will go up. Because as more people from the top come down and push, there'll be more pressure at the bottom of the pyramid. And you'll find very unsuitable accommodation for people, which is very below living standards. Those prices will go up. So the problem we are talking about here, the real estate issue we're talking about, it's almost it's a big problem, right? And
Jubril.
it's one that needs a holistic solution, not just for Lagos, but across the country.
Thank you, Jubril. So very interesting insights there. I think we need to, you're right, we need to be thinking about both ends of that pyramid. You're absolutely correct. I think we're about done. Just before I hand it back to Michael and the team, I would like to ask everyone for their thoughts, just a couple of sentences on, so if you had, if you could start all over again, what sectors within real estate would you be pursuing? I mean, would you stick with where you are, or do you think there are more exciting parts of the industry you'd be looking at? Let me start with Mr. Williams.
I think I'll go back to where I said, which is that as an entrepreneur and if you're a developer, you have to be an entrepreneur. You have to be aware of what your businesses, what is going on in the spaces that you are creating. So just as much as it is important for a developer to develop the bricks and mortar specifically for the spaces that how they want to be used, it just takes a little bit more thought and a little bit more interest to also look at the actual business that is operating there. And it might be a very intrusive idea, but I think that's the way I would prefer to consider myself as a developer, not just the bricks and mortar, but let's have a partnership on the business that's actually running there. I think that gives you more responsibility, and it gives you more feeling for what the end users need. And I think the profit is better shared that way. It's just a matter of setting up some sort of attitude when you are developing that this person is going to use it. So the knives and forks have to be here. So the tables have to be like this. And if you are thinking that deeply about bricks and mortar, you should also share in the business. And I think that's the way to go.
Thank you, Mr. Williams. Olaide, would you, well, actually, I think we know the answer for you because you pressed the button very recently, but for the sake of formality, what would you do? Would you stick with it? Would you rebalance what you have?
I think for us, like we said, it's a function of research into lifestyle and ensuring that whatever development you're building is based on a particular lifestyle for a given area or for a given class of people that you want them to tap into your vision for the assets or the mix of assets that you're trying to pull together. And that's what put us in the path for Popular Key. I mean, as far back as a year ago, we had that in the offing, and we put that all together. It's just coincidentally now happening during the COVID period, and it seems to obviously be answering the questions of everything around COVID, which is what mixed-use development sort of do. Of course, we're all impacted, but in terms of response and being able to maneuver and be able to move forward, makes it slightly easier or better, let me put it that way, not easier, to move forward. For us, the mixed-use nature and putting together something that has a full blend of lifestyle development is very key for us, and that's why we've positioned and continue to position ourselves as Purple in that manner. So, clearly from our Lekki development, what is taking a significant proportion of the development size when you look at the GBA or the GLA is the serviced apartment portion, which of course gives the shorter end of being able to turn around on a sales perspective. And bringing sufficient or significant sales funding, while you also have the other commercial ends of it that have the longer term perspective to it. So a good mixed use of your capital structure, your funding structure, of your continuous revenue structure is important. And now you think about real estate or commercial real estate going into the future. Yes, we've pressed the button, but doesn't necessarily mean that next year or later this year we may not start something totally different, because real estate in itself just brings you a complex of different ideas and perspectives. And when you look at Nigeria, we're far behind in terms of where we ought to be for real estate across the various sectors of real estate. So we cannot really pinpoint and say this particular one is the way forward. We can always say that we have deficits in all different areas, and definitely all of those areas are exciting in different ways of form, and depends on timing as well.
Thank you, Olaide. Thank you so much. Paul, your thoughts?
Thank you. Well, to understand the future, what we'll do in the future, I suppose we look at the past, and the past is surrounded with problems. So I believe opportunities come out of all the challenges. Would I do anything really differently? I think real estate still is the best long-term defensive store of wealth in this country. What's the other thing that's happening in this country from an opportunity perspective is the demographics. There's a young crowd, they're diverse, they're dynamic, they're as entitled as they can ever be. So they want more, they want it faster and quicker and cheaper and more efficient. So, like Olaide, I will stick with that whole mixed use philosophy. I think that it mitigates all the challenges that we've talked about, infrastructure, finance. It's easier to finance. The multiplicity of revenue lines as well leaves you a little bit less vulnerable to times like this. It's easier to consolidate things. I say, put all your eggs in one basket and watch that basket carefully. Basically, success, I think, is born from flexibility and choice. And that's what people want today. Flexibility and choice. If you give it to them, I mean, eventually, obviously, this whole theory is built on the fact or the fantasy that Nigeria is too big to fail, right? And we'll not only survive, but we'll thrive. So I will leave it there. As I say, necessity is the mother of all invention. Yeah.
Thank you, Paul. Jubril, I mean, I'm going to ask you this question slightly differently, which is that what, putting on your advisory hat, and I know your advice is expensive, but what sectors do you see thriving? So if we are looking as an industry for occupiers, the best kind of occupiers to have, what segments of the economy do you see thriving? Is it technology? Is it telecoms? Is it pharmaceuticals or healthcare? What do you think is very exciting, and what do you think has a very fast growth trajectory?
And that's a very interesting question. I have to give it a bit more thought. But if I were to answer off the cuff, the truth is we have opportunities everywhere because we have problems everywhere, right? And we need to have a holistic approach and integrated approach to solving all of these problems. You can have technology and all these lovely things, but if you don't have infrastructure, how does that help? You can build a massive home or developments in Lekki. If the traffic or the roads getting there are bad, you're affected, right? If there are no street lights and people get attacked in the evening because there's no police presence, there's no security, no one's going to come to your place, right? So there's so many issues. But to take it back to real estate, I remember growing up, my father taught me that, look, Jubril, poverty is a big problem, but if you solve accommodation, it's half. That's the way he puts it. Poverty is halved. I think one of the things we need to do from a holistic point of view, and this involves all stakeholders, is to solve the real estate problem. As I said before, I firmly believe we can build our way out of an economic contraction or recession. We just need to find the right structures to do it.
Jubril, thank you. That's a wonderful way to close the session. So thank you to all of you for your wonderful insights, and thanks to the audience for the engagement over 2 hours. We know that your time is very valuable, and I'm sure we've gotten a lot of food for thought for all of us in this industry. Michael, over to you.
Thank you very much, Lanre, and thank you, our panelists. Most grateful. Like Paul said, real estate is something that we cannot not talk about. It's extremely important to the fabric of the society and to Nigeria as a whole. In fact, I would say that from a personal experience, I think I've advised on more real estate deals in 2020 than I've advised on real estate deals in my decade of running my law firm. So it just shows that there's something happening. And these are typically big ticket deals. So it's either somebody is trying to use the capital markets to finance rents, where I pay your rent and you pay me back over a few years, or somebody is trying to use the capital markets to finance mortgages through the Federal Mortgage Bank and things like that. Or it could even be like a major project like an arena. Interestingly, we also worked on the Campbell Center with Mr. Williams also. And I think back in the days where Olaide was still a millionaire, before he became a billionaire, he appointed me as one of his lawyers for the Purple Maryland Mall. But I guess now that he's a billionaire, I don't know. It is what it is. But the truth of the matter is, I think real estate is a sector that we have to just keep talking about it. And the government is quite key to whatever we want to do in that sector. And things are happening. I see certain interesting things happening in this space. Even from our law firm alone, at least we're working on 5-6 major real estate deals that we think when they launch, it will be phenomenal. So once again, thank you for joining us, to our audience. 2 hours on a Friday. You've been there with us. Thank you very much. Our panelists, thank you for giving us your words of wisdom. You know, there's a lot of experience in what you've said to us today. Very practical, very hands-on. Thank you very much. And Lanre, thank you very much. I see that you're in London, so thank you for joining in. Thank you guys. God bless. Have a good weekend, and possibly buy a nano from Olaide.
Buy a nano, definitely.
Thank you.
Thank you.
Yeah, bye.
Bye.
Yeah, bye.